Welcome back to the What's More podcast. I'm your host, Quentin Harris. You are dialed into episode 193 as we're releasing this here on Labor Day. And, it's ironic we're doing that. I kind of saved this one in the bag a little bit here because we're going to talk about labor. We're going to talk about the labor market. We're going to break down Jackson Hole, the Powell episode that took place there as far as the speech that he gave. And the time has come. The time has come. We've been talking about it. The time has come for the Federal Reserve to finally acknowledge the rate cut. And it's all but on the table with a couple of questions. Is it going to be 25? Is it going to be 50? Hell, is it going to be 75? And that's So let's get right to it. So obviously, this is a win for people like myself who have been saying, hey, listen, this time has come. We are here. It's the rate cut from the Federal Reserve is happening and the impacts that's adding to the markets here. So last Friday, Jerome Powell at the Jackson Hole meeting. This is a meeting that they go to usually once, maybe twice a year, and they talk about what's going to happen as far as the remaining portions of the year. In this speech that he gave, he essentially basically conceded to the rate cuts. I mean, let's just call it what it is. He's come out and he said, listen, we are going to have it. We acknowledged a couple of things. And some things that I think that he's acknowledged is obviously the labor market. And we're going to talk a little about what's going on there, as well as inflation that they've become more comfortable with. But as again, I said, as leading to this podcast, the question is it going to be 25? Is it going to be 50? Is it going to be 75? I'll lead with, I think 75 is off the table, but we'll talk a little bit about where we stand as far as 25 and 50 and our thoughts. So the Fed has recently acknowledged that the labor market's been a major portion. It's almost leading me to question, is this no longer a fight against inflation, but more of a labor market fight for the Federal Reserve? My co-host Daniel Halverson and I have talked about it would take a labor market to change their decision, and that's what's happened. And the fact that we've been stating that for a while makes you think that, okay, wait a minute, is the decision from the Federal Reserve predicated on inflation getting a 2% target rate, or is it, hey, listen, the economy is getting bad and honestly spooking them a little bit? And for those who've missed our previous episodes, a few months ago, we went as far as saying, hey, listen, here is a chart. And I'm going to have Charlie, my producer, pull this chart up here. We've been in a couple of our episodes. But it's a chart where it shows the 19 Federal Reserve members and their level of comfort with the unemployment rate. Now, at the time when this chart was produced, the unemployment rate was right at about 3.8. And so 4 months later, this unemployment rate is at 4.4. So keep that in perspective. But the chart reflects that somewhere between 3.9 and 4.1, the vast majority of the Federal Reserve became a little, I'm not really liking that unemployment rate. And quite frankly, that's a level of uncomfortable unemployment. Because the thing with unemployment is it's a runaway train. Once it gets going, it is hard to get that thing to stop, because what's causing that unemployment is uncertainty in the market. And quite frankly, the tightening of the restrictive policy the Federal Reserve has had the economy in is causing employers to lay off. Now, this is nothing new. We've seen this around the country. I mean, heck, yesterday, a headline from Apple, I'm recording this on Thursday here, the headline from Apple essentially said, a very rare wave of layoffs for Apple. And I mean, it's even impacting companies at that level. And that's because the economy is tightened and we've gotten to a point to where unemployment is starting to take off. And that's a concern for the Federal Reserve, because that starts to impact lots of layers of the economy, not just job losses. So I'm going to put that graph up here. You can see at 4.1, 17 of the 19 Federal Reserves are like, hey, we need to start cutting rates. 4.4 unemployment, well, I think all bets are off the table. And I think that's what's important here. So we keep hearing that the employment numbers are not bad. That's interesting, because you look at from the administrations in office, it talks about the employment numbers aren't bad. They're not the worst they've been. They're not bad. You got to take into account that there's more employees that we've had before. But there's something interesting about this. So the number that's being reported, that 4.4, that unemployment number, if you look at the U6 number, now see, I think this is important because I'm going to make a statement here that I think gets lost in the headlines. Matter of fact, I haven't read it in one headline yet, but I think it's really important. So the unemployment number that's reported, that doesn't account for all the people that are unemployed. It only accounts for the unemployed people that are receiving unemployment benefits. And so when you get into that U6 number and you look at the total amount of people that are unemployed, it's actually the highest of record right now. So you've got people that are unemployed, not getting unemployment, that just aren't working. And that is a larger issue. And I think Jerome Powell has seen that. I think that the Federal Reserve is very aware of that. And I think that's something that's driving this notion that, hey, listen, let's go ahead and give the market what they want. The rate cut is happening. We've been tightened for so long. And we talk about that water spigot analogy. They're going to turn it on. They're not going to turn it two twists to the right, but they're probably just going to ease into it where we get some drip coming out of that faucet. And that drip would represent money being pumped back into the system, because when money gets cheap, it does go back into the system, figuratively speaking. But since we started this podcast 2 years ago, I've been saying that the Fed, for the long time, is not the most independent of Feds. See, the Fed is supposed to be independent. And I thought for many a times that the Federal Reserve was more structured to help the economy in a manner of really fueling the stock market, because as the stock market, the equity market fuels, so does the U.S. economy. It roars. And I feel like what I saw happen over the last really 30 days just further confirmed that suspicion that I had, because the Federal Reserve came out of that last meeting and they said, you know what? We're not going to make a rate cut. Now, the market was anticipating a rate cut. They didn't do it. And furthermore, that sent shockwaves around the world because other central banks had already started lowering, but not the United States. And then we see the stock markets around the country have a particular moment where, oh my gosh, it looks like we're retreating significantly. We had some of the larger losses that we've seen in one day and over a week than we've seen in quite some time. And that, I think, was the whole idea that we've talked about with the Federal Reserve. And we've been using a term, like I said, for the last 2 years here, we've been saying the following things. The Federal Reserve will go until they break something. They'll go until they break something. I think you saw not just a crack. I think you saw how they could damage, and I'm very sure they saw how they could damage the equity market in the United States. And what did the Federal Reserve do? You had these pundits, these people in the news. The panic button was, oh my gosh, if you watched any news outlet when the stock market had those declines, that major one, and then the follow-ups over the rest of the week, what was everyone on the news stations and CNBC and Fox, what were people saying? The Federal Reserve has to step in with an emergency rate cut. That was not going to happen. That was never on the table. But that's the level of pandemonium that was taking over. So you look at that, and then what does the Federal Reserve do? They do what they always do. They stepped in, and they didn't just give a smoke signal to the equities market. All of the Federal Reserve members who normally speak amongst to the news outlets, plus Jerome Powell, all started getting on the same page for the first time. And we haven't seen this really since the last 26 months. They all got on the same page, and they started talking about, I think the time has come to cut rates. I think we're at a point now where we need to look at a rate cut. I think, and the message was the same. It may have been delivered 24 different ways, but it was the same. And the same message was the rate cut's coming. That wasn't a smoke signal. That was a direct shot. And then what happened was the equity markets checked up. And not only they check up, they've recaptured and maybe even gained a little bit more than what they lost. And that was to satisfy the appetites of the market, because the market anticipation was, hey, listen, we are going to get a rate cut in July. They didn't get it. And then all of a sudden you saw what happened. Now they anticipate the rate cut coming because the Federal Reserve is all saying it's coming and here's where it's coming. The question is it going to be 25 or 50? And I think that's important because, again, that reaffirmed my suspicion that the Federal Reserve might not be so independent as much as they are a little dependent on watching that equity market here in the United States. And I'll say this, there's another term that I really like, fishing with dynamite, if you may. And I've said this more than once on the show, but the Federal Reserve is an interesting machine, because if you think about fishing with dynamite, you take a stick of dynamite. I've never done this, but I can only imagine how it would go. But you throw it in the water and then it explodes, right? And depending what's on that water and where it exploded, it's because something's going to surface to the top. And when I say fishing with dynamite, I'm using an example as if you were doing that in the ocean, right? If a grouper or a snapper or some of the smaller fish surfaces, that's not cool to do that, by the way, but I'm saying in this analogy, if it surfaces, okay, not cool, but that's a smaller fish. But if a whale surfaces, well, you got a big problem, right? And it's a big problem. Oh my gosh. And the whale in this case, I think, is the stock market. And my point with that is, when you're fishing with dynamite, there's always going to be casualties. But when the big one surfaces, that we can't have that. And in the economy cycle of things, in this particular case, the whale, I think, was the stock market. And I think that's what's causing the Federal Reserve to check up here and go, okay, it could also be the labor market, because that's what's happening as well, as the labor market seeing significant deterioration. Now their job is to stop that. And here's the thing. Jerome Powell said this. He acknowledged that he's comfortable with the target rate of 2% and that they've done enough to get to that and that they've done enough to achieve it. Well, they're going off of the core PCE, which is about 2.5. which is not 2%. And I agree with him. They've done enough. I just question, why now? What's caused that? It has nothing to do with inflation. It's 100% about the labor market. And I think it's interesting because I go, well, you've gotten to 2.5, but you didn't get to 2. So your target rate's 2. Why? Well, it's not because inflation's getting better. It's 100% because of the labor market. And I remember, this is the same person that said they weren't worried about inflation, that it was transitory. This is the same group of people that said this will pass, it's no problem. So they have a history of just ignoring some things and hoping that it will pass, when in fact there were countless people going, that inflation is not transitory. And it took the collapse of a banking system some of the largest collapses we've seen for the Federal Reserve to go, oh, wait a minute, maybe this inflation thing's a little bit more worse than we think. And then all of a sudden we get massive rate hikes that we haven't seen over a historical period of time. And that's how they fixed it. And so I would say that's how they addressed it. I wouldn't say they fixed it. That's how they addressed it. So the labor market is the reason why. It's not that inflation is meeting the target rate. It's not that inflation is taking care of itself, even though I think that stuff happened probably 4 months ago. I think that what they're recognizing is that the labor market is in particular shambles, and they need to address it very quickly. And so I think sending those direct signals back to the labor market direct signals back to the stock market improved that. And so I will say this. Here's something that's interesting as I pull up some notes here I'm looking at here. What happened in the labor market to cause them to check up and go, yeah, besides the unemployment rate smacked them in the face at 4.4, which could get worse on September 6th. We get more employment numbers. But what changed? Obviously, in over a 4-month period, we went from 3.8 to 4.4. If you recall, I talked about this meeting we set in with Raphael Bostic, who is just hell-bent on we're not changing, we're not doing anything, nothing. Except the only thing that could cause us to pivot or change would be the labor market. If we see weakening signs of the labor market, that would cause us for a pause to go, yeah, maybe we need to back off and start becoming less restrictive, right? Well, here's how this has happened. Since that time, the ADP private payroll numbers, that's a job report that we get two of them. We get ADP and we get the BLS. The ADP has only gotten worse. It's not met expectations, and it's been below for the last 4 readings. So that's a sign on the private side. Why is that important? Well, because the private side is where the larger payrolls are. And then the BLS numbers, which oftentimes I refer to as the BS numbers, because they are coming in with multiple revisions from the previous months, which are downward and negative. And I'll talk about that here in a minute. But the BLS report, which is non-farming private payroll, this is a heavy dose of government jobs is what you're seeing inside of this. That number recently has been a swing and a miss, to the tune that they even did a revision going back for the previous year. So they did a revision, and how this works is each month we get a payroll number from BLS, and then it comes out and it says, hey, revision from the previous month. So there were some cases where they said 370,000+ jobs were created, and then the next month you get a new one where it says 270 something were created. Downward revision from the previous month, 80-something thousand jobs, right? Meaning that basically like we overstated the amount of jobs created by 80,000. And there's reasons for that. We've talked about this on the show. You know, the birth death rate model, where they essentially say, hey, listen, for every new job or new company that's created, you know, if you create a new company like this podcast, it's a company, there's this assumption that I'm creating X amount of jobs, and they put that in the report. When in fact, it's me and my producer, Charlie. So there's 2 jobs created, right? But they may be accounting for 10. So that's overstating 8. And that's how that works on the birth death rate model. And so oftentimes those numbers get skewed and you have a revision. I equate it to, hey, I always tell, look at an academic way. For example, hey, your teacher tells you get an A on the test, and then a month later there's a revision and they go, well, you know what? We have to downward revision that A to a C. Sorry about that. I overstated your grade. Like that's how that's working at that level too. It'd be exactly like that level. So for the last year, the BLS report accounted for how many missed jobs that they actually put out there. This number is shocking. This is the one that should make everyone wake up and go, wait a minute, the labor market is not as good as they're telling us. Guys, that was 818,000 jobs. So they overstated the job count by 818,000 jobs. That's not a mistake. Like, you don't make that kinds of mistake. Imagine going to your work and you're like, hey, listen, I miscounted the product by 818,000. Like, we actually didn't produce 818,000 at the number I said. Or, hey, listen, I miscounted $818,000 in our payroll. That is a number that would get people fired, is what I'm saying. That's not a number you just happened to put on paper. A lot of that, I'm assuming, and I'm going to say it, that's by design. That was 100% by design and misleading. And in this particular section, there's a lot of government jobs created. And when I take a look at government jobs created, I'm like, hey, listen, are those jobs still in place? Were they created for 60 days? What's going on? But that is a misstated number on there, and that's showing up. And I think that's also Jerome Powell saying, hey, listen, I too got this number. I see what's going on here. We're getting ready to go into the next Federal Reserve meeting. Wait a minute, this job market, we got unemployment at one of the highest rates we've seen in quite some time, pre-COVID. We've got a negative downward revision of almost 1 million jobs. That's not a good place to be right now. Oh, and by the way, we've got more people in the United States that have second and third jobs than we've ever had of record before. That's not a strong economy. That is damn sure not a strong labor market. And that, I think, is going to be the driving force for the Federal Reserve's downward rate revision that we're going to see. downward rate hike that we're going to see. And I think there's a high chance that it's going to be 50 basis points. Now, I think if you're looking at, if you're just looking at the odds makers, right? Because Powell says the time has come, right? The time has come. September 6th job report, I think, is the one that's going to dictate this. That job report that comes out, if it's in line where we are now, meaning it hasn't improved, it's in line, or it gets worse, you can guarantee 50s on the table. But until that job report comes out, 100% 25 basis point cut is on the table. And the Fed futures say, hey, listen, 100% change of 25 basis cut. There's a 33% chance of 50 right now. So 33% chance of 50. That number could completely flip-flop with this September 6th reading that we're going to get. And then finally, here's the interesting part. That same group, and they've been pretty dead on, says there's a 73% chance of a 100 basis point cut by the end of the year in total, all of it being 100 basis point. That's interesting to me. We have 3 more meetings, so 100 basis points amongst the 3 meetings. That is going to be a big win for the market. It's going to be a big win for real estate and a big win for buyers out there, because they're going to see that downward trend of the rates that we've been speaking about are happening, and there is a high probability by the end of the year in that fourth quarter we're going to see those 5s we've been anticipating and waiting on. And when that happens, oh boy, look out. It's going to be a refinance central. It is going to be a musical chair situation that we've been discussing on sellers becoming buyers and multiple buyers buying homes. And it is going to be a cycle of multiple offers, and it's going to create a whirlwind of real estate transactions during that time. And here's the other thing. You look at real estate prices, I mean, they're at a record high. Another record high. And I know many of you argue with me on this, that like, hey, listen, how much higher can it go? I think it's a great question. And every time I think we've gotten to the top, we reach a new high again. As these rates go down, you can ensure the higher will continue. That's not going to stop it. That's actually going to add more fuel to the fire. And I'm not sure that's a win. I'm just saying that's what's going to happen here. But the good news is affordability will go up as these rates go down, and there will be a great window of opportunity to capitalize on that. And if you're in real estate, if you're in mortgages, and you're a home buyer, wow, the time is going to be right for us. Also, if you're a seller, what a great time to maximize the price of the home as you go to sell that. But nonetheless, September 16th is going to be the day. Can't wait for that, because I know it's going to be a rate cut. It'll be a big celebration in our industry. The question is, will it be 25? Will it be 50? I don't know. We'll sit around, wait for that to happen. I'm sure we'll discuss it in more depth in here, and I'll have my co-host Daniel Halverson back as we discuss the outcome of that and the impact into the mortgage lending world on the next episode at What's Your One More. Till then, guys, please share this podcast if you would. 5-star review it. Leave us some comments. Love the comments you guys are putting on there. Check us out our YouTube channel at What's Your One More with the number 1. My producer Charlie's going to put all those graphs I've talked about on there and more inside each episode. And finally, guys, hope you have a great Labor Day. Enjoy the long weekend. We'll see you at the next episode of What's Your One More.
I got one more shot, I'm gonna make it. One more chance, I'm gonna take it. I meant it when I said it, now it's time for me to do it. I got one life to live, so